If anyone would like to turn on their cameras, please feel free. It does make it a lot easier, a lot more enjoyable for us, rather than just speaking to blank screens. But if you're not able to, that's absolutely fine. All right, last investing one-on-one session of the 6-week course. If you missed any of the previous ones, they're all on YouTube, blah, blah, blah. Just 2 very quick things before we get started. Firstly, as you will hopefully have seen now by either your emails, the WhatsApp chat, social media, we are well into our Fight 2021 fundraiser for Mind, the mental health charity. We have so far raised almost £14,000 together with societies across the country, with students across the country, alumni, professionals, other firms. It is amazing, and we really want you guys to get involved. And as of today, you have the chance to win a new set of AirPods if you get involved. So if you check out our latest Instagram post, you can see how to do that. And it's for a great cause. It's for student mental health, so definitely get involved. And the second thing is hang on one second, I'm just letting someone in. Yep, we have our AGM, our annual general meeting coming up very soon, where we're going to elect a new committee for the next year. So if you want to be on our committee, if you want to have my role, if you want to have Ethan's role, if you want to have any of the roles that we've got going, check out our social media. There's a bit more detail, for example, on our Instagram page about kind of what each role entails. And all you need to do is send us an email with your CV by Friday latest, just letting us know that you're interested. And then we will send you some more information. So yeah, definitely, if this is something that you're interested in, drop us a message. And without further ado, Henry, take it away for the last time, I think, this semester.
Awesome. Lovely, David. Very warm welcome back to everybody for this session on valuation. I know it's been a really sought after session. So today we're going to finish off some of the relative stuff. Last time we were looking at certain ratios like the price to earnings and the PEG. This time we're going to extend that a little bit, and then I'm going to talk you through how I like to do value companies. Basically, we'll look at a discounted cash flow. We'll look at something else which is similar to what the institutions do, but to be honest, a lot of it I've just kind of made up and done what I think is good for valuing a company. So I'll show you those two. Probably going to do the first half hour on PowerPoint, second half hour on my Excel. Any questions, feel free to ask, drop them in the chat, give a thumbs up on the thing. You can ask them verbally. I'll pause every few slides. Disclaimer, blah, blah, blah. And a welcome. Is this anybody's first session? I always like to ask.
If it is, just turn on the mic, say yeah, put your thumb up on Zoom, something like that, just so we can see.
Yeah, I'm the first session.
Nice. We got a couple of people, 3 people, 2 people.
Oh, sweet. Okay, well, welcome. I mean, welcome. These sessions are one-on-one, so yeah, they're very much, we're trying to make it as simple as possible. If any of the content you find tonight quite difficult, I'm very happy to explain it as we go. But also we have all of our previous sessions on our YouTube channel, which is just here, University of Birmingham Investment Society. I've got my own one as well. I'm publishing stock analysis, investing 101 on there as well. If you like this content tonight, I'd really appreciate checking out my YouTube channel. It's helping the channel grow. And there's a lot of value added potentially on there if you're kind of into this stuff. Right, and here's the book giveaway for tonight. It's Strategic Value Investing. This is quite a comprehensive book, but it's full of knowledge and wealth. Right, okay, so here we go. So this is where we were at last time. We were talking about the PE ratio, and we were talking about the advantages and disadvantages of the PE ratio, right? So very, very basically, you've got price, you've got net profit of the company, and you're working out how many times over you'd have to pay for like $1 of company earnings. So price to earnings was 14, you'd have to pay $14 for $1 of company's earnings. That's a very basic ratio that we went through last time. And where we kind of finished off was I talked about the disadvantages of the price to earnings, right? So even though it's great and it's a very basic ratio that everybody uses, why is this? Sorry, I'm getting distracted by this moving. Okay, yeah. Even though it's a very basic ratio and very useful, some disadvantages of it is that it doesn't take into account a company's financial debt structure. Also, the bottom of the equation, the earnings part of it, it's often very subjective, which isn't particularly good when there's different types of earnings per share that can be used to calculate it. So we're basically looking at an extension of that at the moment. And okay, so what's the improvement here? An improvement on price to earnings ratio that I wanted to talk about tonight is something called enterprise value to EBITDA, which might sound quite financial and quite scary off the bat, but I'll go through this in detail now. So does anybody remember what this acronym EBITDA stands for? No, to do with the income statement.
Earnings before interest, tax, depreciation, and amortization.
That's the one. That's the one. Yeah, so that's it. Like, that's basically what it is. It's like an earnings figure before certain earnings have been taken out. I'll go through exactly why this and why this EV to EBITDA is using EBITDA in a minute. Firstly, I wanted to talk about the top part of this equation, enterprise value. So what is exactly enterprise value, and why is this an improvement on the PE, which uses market cap? Okay, this is the equation for it. So enterprise value is basically the market cap plus any debt, and then minus any cash that the firm has. So it's basically market cap plus net debt. I like whoever's got the University of Birmingham filter. That's pretty cool. Right. Okay. So enterprise value. So how's the best way to explain this? Market cap is basically how much you would buy all of the equity value of the investment for, right? So if it was listed on the stock exchange at $100 per share and there were 1 million shares, it would cost you $100 million to buy the whole company. That's what the market cap is. But why is this formula where you're adding the debt and taking the cash? Why is this considered an improvement of the market cap? Basically, it also takes into account everything that the bondholders own in the share, right? Like when looking at market cap, you're only looking at shares. You're only dividing the total value of the firm by the number of shares. You're not considering the debt value in that part of the business as well. So a good analogy for this might be, okay, say if David was like trying to sell me a pair of running shoes for fight, right? He's trying to sell me some shoes, and the shoes, he said, you can have them for $100. That would be the market cap. It would be how much he's initially listing the shares to the shoes to buy from $100, right? Imagine then if in one shoe he'd hidden a $20 parking ticket. So you've got $100, but he's hidden a $20 parking ticket in the shoe. Effectively, that's going to add to my total cost of buying the shoes because those shoes come with some debt. Imagine then in the other shoe, if it had been a bit kinder, he'd have, say, given me $30 in cash. So I've actually netted $30 in cash from buying those shoes now. So this is kind of the analogy when you're looking from market cap to enterprise value, is that the market cap of the shoes might be $100, but I've got to take on $20 in debt, but then I also get $30 back. So the enterprise value of those shoes would be the $100 market cap that I'd initially pay for the shoes, plus the $20 debt that I've got to take on, but then minus the $30 in cash. So overall, the enterprise value would be $90. And that's the improvement, is it takes into account everything that the business owns, but then also the cash that is effectively just extra cash that you can then take out of that value. So if you're like buying something for £100, but it has like $30 in cash that goes with it, you're really only buying it for $70, right? The other part of this equation I wanted to go over was EBITDA. As somebody correctly said, interest, tax, depreciation, and amortization. So it's earnings before all of these metrics, as opposed to just looking at net profit. So why is this important? It's more focused on a company's pure operating profit rather than the net profit, which has all of these weird expenses taken out of it. Interest is taken out, the tax they pay is taken out, and also depreciation and amortization. So just to break this down a bit further, you've got the interest. That's not really a core part of a company's for God's sake. I'm just trying to get that. Okay, there we go. That's not part of a company's core operating profit, because it concerns how the company is financed. It's looking at interest rates, which might be out of the company's control, and it is an expense for the company, and it is important, but it's not so much part of its core operating profit. Exactly the same thing with tax, right? Like tax is subject to regulation and changing rules, and that might be out of the company's control. Like, for example, the UK is raising its corporation tax, right? I think by 2023, it'll be up to 25%. And it's not so much an operating part of the business. It's more just this extra expense that a company has to deal with. The same thing with depreciation and amortization. So these are highly subjective. I talked about depreciation and amortization in the past couple of sessions. If you have like a factory where you want to kind of spread out the cost of that factory over time and say this factory has 20 years to live, instead of like the 20-year purchase all going up in one go, you'd kind of depreciate it over a 20-year period, so your cost is spread out. Key difference between depreciation and amortization is that depreciation is tangible assets, factories, offices. Amortization are the write-downs of intangibles, so that would be things like a company's brand value getting eroded over time, or maybe a patent that a company has. Yeah, that's enterprise value. Do we have any questions, David?
Not yet, but if anybody has a question, feel free to pop it in the chat or turn on your mic now just before we move on to the next bit.
Okay, cool. We have a lot of deep content like this to get through tonight. Please let me know if I'm going through anything too fast. I think what I've done is probably kind of the right pace, given that we've got an hour. But I would say that, you know, if you take the time to understand these kind of concepts, you will extract a lot of value from this session, because this is really kind of delving into the meat of how to value a business. Right, so let's kind of think about these two metrics together. So PE and EV to EBITDA. EV to EBITDA is very commonly used by analysts, very commonly used indeed. So here's the equations again, just if anybody needs a reminder. So the PE multiple, it can also be looked at on a per share basis. So like the price per share divided by the earnings per share, but I've just put it as total market cap over total earnings, just to give it more of a direct comparison to EV to EBITDA. So let's say for a second, if, okay, let's look at the characteristics of a firm. If a firm had high levels of cash, and it also had low levels of debt, and also all of these ITDA expenses, the interest, the tax, the depreciation, if they were very high, which one of these ratios would come out lower? Or which one would come out higher? Company's got high cash, low debt. The ITDA expenses, interest, tax, they're very expensive. Can anyone figure out which one we might see lower and which one we might see higher? Take a moment to think.
Don't be afraid to say something, even if it's the wrong answer. We're not going to judge you.
Mm-hmm. Yeah. Even if you're just working out in your head, it's always important to kind of like stop and think about these let's think about what I'm saying, because I don't want it to just be like, you know, going across at 100 miles an hour and then not really getting a time for anyone's brain to process it. Because I appreciate these new concepts for a lot of people. So we've got a firm, it's got a lot of cash. So that would reduce the value of, that would reduce the costs when you buy something, right? As I said, David's running shoes, $100, but he might hide $30 of cash in one shoe. That reduces the cost of me buying it. The same thing if it has low levels of debt, that would also keep the costs of it down, the raw cost of buying it. So the enterprise value would be much lower. If it has high ITDA expenses, if it has high interest expenses, tax expenses, and depreciation expenses, that's going to make the bottom part of the fraction of this equation much lower than this equation, because with the EV to EBITDA, these expenses haven't been taken out yet, but when the expenses are taken out of this, it's going to make it a lot lower. So the price to earnings ratio is going to have, the market cap is going to be higher than the enterprise value, but then the net earnings are going to be lower than the EBITDA. So we would see a lower EV to EBITDA compared to the price to earnings. I'll take a minute for that all to sink in. But that's kind of how you want to be thinking about these two equations and their relationship. So if a firm's got loads and loads of cash, that's great because it reduces its enterprise value. If it's got low debt, that's also great because you're going to be taking on less debt as a shareholder. So that is also going to improve the enterprise value. But then if it has high ITDA expenses, That's not necessarily a good thing or a bad thing. I mean, it kind of depends on where those expenses come from and if it's logical. But obviously, if these expenses are very high, it's going to bring down the net earnings, but it's not going to bring down the EBITDA because they're not reflected in this equation. And then if you think about the flip side, right, like if a firm has barely any cash, but you're taking on loads and loads of debt, that's going to make the enterprise value really, really expensive, right? And then if they have very low EBITDA expenses, that's going to make these two, the denominator of the equations pretty similar. So you've got to have two equations. One where the enterprise value is going to be really, really high, and the market cap is going to be much lower than that, but the denominator is going to be about the same. So in this case, you're going to see an EV to EBITDA that's much higher than the price to earnings. So that's kind of how you think about the relationship between these two. Now, one crucial question, just to sum up relative valuation, is how do you use them for comparison, right? So, in fact, do we have any questions on this, David? Just before we go on to
no questions, but I will say if that went over your head a little bit, it'll be on YouTube hopefully tomorrow for you to catch up on. So definitely have a look at that and spend a couple of minutes just going over that to make sure you've got the hang of it.
Sure. Yeah, I think 100%. It's good because this equation has so many components to it. It's just useful because most of us can get our heads around PE relatively easily, right? It's just the price, the whole business, and then you've got the net earnings. What's the multiple on it? With EV to EBITDA, obviously there's a lot more components. So I think thinking about it like this really helps to kind of grasp how they relate to each other. But anyway, look, both of the equations are useful. And what you want to think about is that all else being equal, usually lower is better. You know, lower might signal that, well, a lower equation is signaling that the shares are cheaper compared to how much they're earning. That might be because they're undervalued, or it might be because for good reason, right? It might be because the earnings prospects of the company aren't very good going forward, or maybe the business is in sectoral decline, and it's, you know, a business that just isn't going to do well in the future. Okay, so using the ratios for comparison, because this is exactly what we want to be doing with these ratios, right? Like that's the whole point of relative valuation, is we want to say price to earnings of this business is 10, price to earnings of this business is 20. How does it look? So what you can do is you can compare them across all different scenarios, right? You can have the current price to earnings, you can compare it across an average of 5 years. You can also compare it to similar businesses, and you can also compare it to the country as a whole. So for this company we've got here, you've got a current PE, it's much lower than its 5-year average, similar to the sector, and it's much cheaper than the country. Here we have EV to EBITDA as well. So we can see for this company, the price to earnings is slightly more than the EV to EBITDA. Like, what does that mean? It either means that because the EV to EBITDA is less, it might have a lot more cash than debt in its, it might have a lot more cash than debt in its balance sheet. So hence that's bringing the EV to EBITDA down, or it might have really, really high interest, tax, depreciation, and amortization expenses, which is bringing the price to earnings ratio up. So yeah, I think the thing is, what I want to say about relative comparison is, I would say where it's most useful, in my opinion, is comparing the business to where it is in the past and comparing it to the sector. Comparing it to the country is also relatively useful because you want to see where the market is going as a whole. But I think the best thing to do, in my opinion, is look at it compared to where it is in the past and look at it compared to its competitors in very similar businesses, right? So like, if you look at a business and it's trading at a much lower PE in the past, you've got to think, is that justified? Like, is the business much worse off now than it's been over the past 5 years? If it is, then a lower PE might be worth it. If it's in roughly the same condition and you think, great, the business looks roughly the same over the whole, then a low PE might mean that we found a bargain in the market. Exactly the same thing as a sector, right? Like if you have companies that all do very, very similar things, and they're all looking like similar growth prospects, but you find somebody that's much cheaper than the sector, then that might mean that they're doing a very good job, and they're undervalued as a company. Have we got any questions, buddy?
Yeah, I've got one that's come through, which is if someone wanted to compare, let's say, sector PE ratios or country PE ratios, what would be the easiest way to do that?
Oh, I mean, the easiest way from sector or country. Okay, I'll tell you how I did it. And it's probably much easier for sector as opposed to country, because for sector, you only want to be looking at a few specific companies, really. You want to be looking at businesses that are relatively similar. Like, you don't want to be looking at, like, I don't know, like all the tech stocks with a sample size of 50, because so many tech stocks do completely different things, right? So, for example, with this Altria one, they make cigarettes. I compared them to the other like big three cigarette manufacturers, which are British American Tobacco, Imperial Brands, and Philip Morris International. And then I literally just took the mean. You can also look at the median, but it kind of depends on where the skewness is, or where the distribution is. So I literally just took the mean of those four, and then I kind of averaged it all out. What I did for the country, to make it a little bit quicker, is you can go online and you can look at the S&P 500, and you can basically like rank them by all these different metrics, right? So like go onto some kind of online database. I use SharePad, but many people do it. And you would look at a PE and you would say rank it. And then a really quick way to do it is that if you say, if there are, I think there are 430 companies in the S&P 500 that have a positive PE at the moment. Obviously, if some of them are making a loss, then they don't have a PE at the moment because they're negative earnings. So there are 430 companies having a positive PE. Just take the 215th one, which is the median, and then you kind of get a median result. The reason that I say median, and particularly over a large sample size like that, is that you might have massive skew. So you might have companies that have PEs of like 500 or 1,000, like we've seen with some of the tech stocks in the S&P 500, like Tesla, that are kind of like pushing that PE up above where it should be, and hence you should kind of compare it to the median as opposed to the mean. You might remember me saying in the last presentation we had McDonald's. We actually had a mean PE of 39 for the S&P 500, right? That gives you an idea. So the mean for the S&P 500 is actually 39 at the moment. The median is 26.7. So that does show you that the skew is pushing up the PE. But to answer your question, I think the easiest way to do it, if you don't want to just like have loads of complicated Excel, is that if you have a large sample size, just rank all of them and then just take the value in the middle, which will give you the median. And usually the median is a much better representative compared to the mean because of this skew that we see.
For sure. Elliot's asked what's typically a low PE, and I guess that just depends on the industry, the sector. You know, for some industries, for some companies, that might be 3, 4. I guess for some, if you're looking at tech, it could be like Tesla, it could be like 500.
Yeah,
so it really depends, Elliot. And just to kind of reiterate something that we've said the whole way through, I know seminar lecturers will say this the whole time, but there's really no such thing as a stupid question, especially here. So if you have anything you want to ask about investment, about what we're talking about, what Henry's talking about, put it in the chat and don't be embarrassed. Like, we really encourage discussion. So
yeah, absolutely.
Otherwise, carry on. I know you've got a lot of slides to get through, but if anyone's got questions, keep them coming, and we'll keep taking breaks for questions.
Awesome. Cheers, David. Yeah, I mean, look, yeah, this stuff is obviously very technical, and it's not easy, and it takes a long time to learn. And I'm always really impressed with people's level of engagement and level of questions. And the great thing about it is, like, once you learn it and once you practice it, it pays off massively. Like, it pays dividends, like, to excuse a pun. Like, once you've got it under your belt and you are just, you're familiar and comfortable with this kind of content, it helps you so much, because then you can like value a company, right? And you can buy the companies when they're cheap, and you can sell them when they're expensive. And we're all young, and you have years and years and years to build your wealth. And boom, you're on the road to building your wealth, running a portfolio, getting the financial career you want. So really impressed with everybody's kind of level of commitment. Yeah, I'm just thinking if there's anything to add with regards to Elliot's question about PE. I would say, it does vary by sector quite a lot. In terms of like the big tech and the FANG stocks, like a PE of 25 is low at the moment. Like Facebook has the lowest PE out of those tech stocks. and Facebook's PE is about 27 or 28 at the moment, I think. And Tesla's above 500, Amazon's like 65, like most are about 40. If you look at the cigarette market, as I said, well, the sector's PE of 12. If you find a PE lower than about 8 in this market, because the average PE is very, very high compared to the past, if you find a PE below 8, more often than not, there's something not quite right with the company, or like, you know, it's not destined to grow. It's probably not a very good business. Yeah, it might be, I don't know, it might be forecast to like, I don't know, have a lot of debt and go bankrupt. Because as I said, the PE doesn't take in, the PE doesn't take into account company's debt structure, right? So I'd say, you know, between 10 and 20 would be good for like a potentially cheap stock. But then obviously when a PE gets to like 1, you have to be thinking about why is the market bidding it down so low. Okay, so this was what we went through last time, where it's like, okay, we buy shares on the cheap, we buy shares when they're below what we think the value of the shares are, we sell them when they're above that value, and boom, that's how we make our money. Now we're going to go through intrinsic valuation, mainly on Excel. I'm going to show you a discounted cash flow, and I'm going to show you my alternative method for valuing shares as well, which not many people have actually seen. But yeah, I'm going to show you how you can kind of come up with this figure so you can stay objective in your investing. You can have conviction that the shares are worth this much. You can sell them. Sorry, you can sell them when they're expensive. You can buy them when they're cheap, and make money that way. So just a couple of concepts with regards to intrinsic value. We're going to talk about discounted cash flow mainly because that's the main one that analysts have been using. That's the one that a lot of people have been asking about. A few things to note. We want to be looking at the free cash flow growth rate, right? So the whole idea behind a discounted cash flow is you want to be thinking about how much the cash flow is going to grow. Just to get everybody up to speed, the reason why we're talking about cash flow, free cash flow, is that that's like the amount of money that the shareholders actually are kind of entitled to in the business, right? That's the amount of money that the shareholders really make or like take home at the end of the day. You have your net profit, you have some adjustment for like inventory, some adjustment for you know, if companies are selling stuff on credit. You then have the operating profit, which is the cash that's coming through to the company every month. They spend money to kind of keep their business afloat and reinvest. That's called CapEx. Operating cash flow minus CapEx. That's the free cash flow. We're kind of, it's kind of what is there for shareholders, right? So that's the key amount. That's the key figure that we're looking at. And that is why it's so important in a discounted cash flow and why cash flow is so highly valued. So we want to be thinking about how fast that cash flow is going to grow. And we also want to be thinking about how much that cash flow is discounted. I'll talk about this concept of discounting in just a minute. And you also want to be talking about their long run growth rate. So how much will they kind of grow in the long run? Here's a formula for it. I wouldn't worry about the maths behind this too much. I'm going to show it way simpler than this. But what you're basically doing is every year you're summing that cash flow up. You're summing it up. You're discounting it. I being the discount rate. You're discounting it year after year after year. And then you add them all up, and then that's the value of the firm, right? The sum of all of the future cash flows coming in, you add them up, you say, this is the cash I'm going to get as a shareholder, add it up all over time, and boom, there you have it. That's the intrinsic value of a firm from a discounted cash flow perspective. Do we have any more questions, David?
No, I don't think so. I think we're all good.
Okay, cool. That's the real basic concept, but it should come more clear to everybody when I show you this on Excel. Yeah, so just to talk a little bit about this concept, the discount rate. I'm sure a lot of people have heard of it, but for those who haven't, the whole idea is that money is not worth the same over a period of time, right? In order to explain this, imagine if I asked you, like, would you prefer $100 right now or $100 next year, right? Like, who would prefer the $100 right now? Anyone would prefer the $100 next year? Yeah? Sharif wants $100 right now. and Tony and a lot of other people. Okay, so everyone wants.
Everyone does. Everyone wants it right now.
Everyone does. David, why does everyone want $100 right now?
Because what's the point in waiting a whole year?
Exactly. If I gave you the $100 now, you could do stuff with that money, right? Like you could buy stuff that's valuable to you. You could invest it, and you could get a higher return. So basically, that's the whole idea, right? You prefer $100 a day because of opportunity cost. Humans are impatient. We genetically programmed to gather resources to survive. So we want to lunge, get the resources as quickly as possible. And the value of money is time sensitive, right? So like you give me $100 today, I could chuck it in an index fund and it'd be worth $110 next year. So the discount rate is what rate of return would we have to want in order to receive $100 next year? A much more clear way of putting that is, okay, I could pay you $100 right now. How much would somebody want if I was to pay you next year, right? Like, would you want $101 next year? Would you want $102 next year? How much money would you want for next year in order to not have the $100 right now? Right? It's probably going to be more than 101. It's probably going to be less than $1 million. And there's no right answer exactly. So the way to put this is like, say for example, if our discount rate was 8%, that would mean that we would be indifferent between $100 today and $108 next year. If somebody was like really greedy and really wanted the cash right now, and they thought, okay, this share is going to the moon, or like, I can just invest this in this project that I think is going to like double my money, then they would want a much higher discount rate. So if it was like $150, and they would say, I want $150 next year or $100 now, then my discount rate would be 50%. And that's why it's important to discount these cash flows, is that like every year the value of money gets eroded. It gets eroded by inflation. It gets eroded because of opportunity cost of investing it elsewhere. It gets eroded because we're impatient. And that's why we have to discount. Okay, so here we go. How to discount. This is a largely subjective process, right? There's no right way. And what I'm going to show you in my models is we're actually going to look at how to value shares with different discount rates, so we can kind of compare them and what discount rate we'll be wanting to use. So it's a largely subjective process. The analysts often use a process called WACC, which I'm going to explain now. So this is effectively how they would do it. Is what WACC stands for is it stands for weighted average cost of capital. They're effectively working out what's the discount of the debt, what's the discount of the equity, and how much debt and equity are in each portion, so we can kind of weight those averages out, and then we get our discount rate. So for example, if the debt discount rate was 4 and the equity discount rate was 8, and they were both equal, so a firm had 50% equity, 50% debt, and it was 4% and 8%, then you would average those out, and the discount rate would be 6%, right? So it's the average of 8 and 4 because they're equally weighted. So that's the whole idea. If a firm was like 100% equity and the discount rate was 10%, then our overall discount rate is going to be 10% if it's got no debt, right? So that's the idea. Let's go through a little example with this. So we've got a discount rate of 10%. We've got a discount rate of the equity of 10%. The discount rate of the debt is 6%. One other concept I wanted to mention is debt is tax deductible. So that is what this KDAT means here, after tax cost of debt. So you can effectively alleviate that cost of debt. So 6%, we can actually take 20% off that. It's tax deductible. So our discount rate of debt is actually going to be 4.8%, right? Or 6% multiplied by 80% because we're taking 20% off. 6% multiplied by 80% is 4.8%. And then you've got your total equity and your total debt. And let's go through an example. So let's plug this into the equation. Here you go. Here we've got a WACC. So weighted average cost of capital. We've got 10% cost of equity. And that's 75% of the weighting. So we're going to multiply that by 0.75. And then we've got the debt. As I said, we're deducting the 20% tax. So we're doing 1 minus 0.2 or 0.8. And then we've also multiplying it by a quarter because the firm is 25% debt. Is this making sense to everybody, or does somebody want me to go through that again? Do we have any questions?
No, I'm not going to lie. I think this is the best, for me personally, the best, clearest way I've seen a DCF model broken down.
That's good.
So on my part, I think it's going well. But yeah, if anyone's got questions, just drop them in the chat.
Sure. I'd really, yeah, it'd be really good to, like, if you have any questions on this now, we can get it nailed now. I think this is one of my last slides, and then we can go over to the Excel. But yeah, it's not. Do we have a question, mate?
We do. It's where has the discount rate come from?
Okay, so where does this come from? So I will go through this more in the PowerPoint, but basically what we're thinking about is what investors want as a rate of return for investing in this company. So for the debt, let's look at the debt first, because the debt's the easy one. What you can do is you can go into a company's annual report and you can look at all of their bonds. And what a company would do, at least if it's a good company and a transparent company, and it should do this, is they will tell you the rates of interest they're paying on all of these bonds. So that's what investors are demanding to invest in that company. They'll say, you know, I want 6% interest payments every year in order to invest in your company. So that's what the investors are wanting for a discount rate for that company. So that's where the debt comes from. You basically average out all of those discount rates. In fact, usually the company in the annual report, it would tell you what the average discount rate of their debt is. Usually if I see loads of different bonds all issued at different rates, I usually just, you know, roughly work it out in my head. If I'm getting 3%, 4%, 4%, 4%, 5%, 5%, you know, 6%, 6%, I usually like put it as like 4.5%, for example. That's where the cost of debt comes from. The cost of equity, I will go through that in the discounted cash flow. I've got the equation in the actual model, but it's basically a function. It's a function of the interest rate. It's a function of the general market rate overall, and it's also a function of the volatility of those individual shares. The biggest factor of those three is the rate of the market overall, right? So, for example, I've got 10% here. If the relevant stock market, like in this case, like the S&P, for example, if that rate of return was like 10% you'd get from the S&P, then that's the opportunity cost of investing in that company, right? Because you could return 10% with the S&P. So that's where the discount rate comes from equity and debt. And as I said, I'll go through the formula for equity when we're at the discounted cash flow model.
Does that answer your question at all, or?
Yes, thanks.
Or,
What about if the cost of the funds comes from the bank loans interest?
the cost of the debt, yeah.
Which one you choose? Is it from the bonds or from the bank's interest loans?
Well, I use it from bonds.
From bonds. Okay.
Yeah. So, I mean, the bonds are usually just more representative. So, like, usually you would see, if it's like a very small company starting up, they do sometimes get bank loans, but it's more about what investors want as a discount rate. Banks are a little bit different, but it's more what the investors like reasonably demand as an interest rate. So I usually use bonds for that. And yeah, that's pretty much it. So here we have it. We've got 10 multiplied by 75%. So that's going to be a 7.5% discount rate. We then got 6 minus 1 minus 0.2. That's 6 multiplied by 0.8. So that's 4.8. 4.8 times 0.25 is 1.2. And then 7.5 plus 1.2 is 8.7. Yeah, there we go, 8.7. So that's just a calculation. As you can see, it's quite a complicated equation, but the maths is relatively straightforward. You just want to make sure you're always right with your brackets, because you want to make sure you're doing like all the multiplications first, except like where you have the 1 minus 0.2, you want to make sure that's done first. And you guys know bid maths, right? Like you want to make sure you have the brackets in the right place, so you don't do multiplications before you add when you're meant to add first. So that is pretty much it. I think that's literally everything for the PowerPoint. We're now going to hop over to my Excel. So I'm going to share a different screen. And we're going to look at.
Sorry, I've just got one more question.
Oh yeah, no worries, buddy.
Which is, hang on, let me find it again. Yeah, do you use the debt to equity ratio to calculate, where it says total equity, total debt? and then the percentages?
You can. Yeah, in fact, yeah, you can. I mean, literally the way I usually do it, you can absolutely do that. Literally the way I would usually do it is like, I'll show you in the Excel in a minute, but I usually just have like total market cap, total borrowing. I add them together to get that total value. And then I work them out as percentages. So like I have total equity, 90 billion, total debt, 10 billion, that adds it up to 100 million. And then like the debt is just 10% and the equity is 90%. I didn't really think of that. You could use the debt to equity ratio. So if the debt to equity ratio was 3, yeah, there you go. You have a debt to equity ratio of 3. Sorry, no, with this one, you have a debt to equity ratio of a third. So you just flip it around. And then you just work out that from that, you want to make sure that you add the whole ratio up. So it's out of 4. And then you just know it's 3/4 equity and 1/4 debt. Okay.
We've got a... I'm just trying to tell if it's a question from Prashant or if it's a statement. Hang on 1 second.
Okay.
No, I think it's a statement.
What does it say?
Cool. The risk-free rate is usually what is used as a discount rate, as this is the interest earnings you can gain with no risk. Generally, these are government bonds such as US Treasury bonds. If you can earn X% return with no risk, you want a high percentage return if you were to invest in something riskier.
Yep. Yeah.
Exactly. You just explain it. Cool.
Yeah, exactly. That's the risk-free rate. We'll go through that because it's part of the equity model. Can everyone see my screen? You can see that?
Yep.
You see the right?
Yeah.
Okay. Okay. Coca-Cola. Here we go. Right. So this is how I would build this discounted cash flow model, and I appreciate there's a lot to look at on the screen right now, so we'll go through it step by step. So what we're doing is we have the free cash flow here. This is every year from 2016. Why are these on here, right? Because I said it's all about the future cash flows and what they add up to. These are just on here to see a general pattern, right? So they're not part of the calculation, but I just use them to see the pattern going forward. Is it big enough for everyone? Can everyone see it? Like, can everyone see this?
Yes, we can.
Yeah, it's all good. Okay. So here we just have the historic growth rate. I don't want this to be too much of an Excel lesson, but like you're just out working out the growth rate like that. And then you kind of have the free cash flow growth. Some people will do free cash flow by like taking the turnover, then taking the margin, then taking how much cash converts into operating cash flow, then working out the capex. And like the reason that I don't do that is that it takes so long and there's so much room for error. You could make like one mistake and like there would be, there'd be one tiny error and there'd be so much room for error. So what I like to do is I like to forecast the cash flow directly. These first 3 years, what I do is I take the median analyst free cash flow projections. So basically what this is, you add up all of the analysts' free cash flow projections, you divide them by the number of analysts, and here you get the mean. And you can see the free cash flow growth. They're forecasting 5%, 5 and a bit percent, 6 and a bit percent. And then I've added an extra couple of years onto here. I'm adding another 5.5% because that looks roughly reasonable given what we've seen in the past. And then what you do is you also calculate this terminal figure, which is basically where you say, right, the model will kind of finish now. I think Coca-Cola will grow at like 2.5% forever. I usually use 2.5% because it's like in line with long-term GDP projections. And I say, right, it's going to grow at 2.5%. We want to take away the premium between the discount rate and the growth rate. And that kind of gives you a figure, which means that you don't have to just like add these future cash flows forever. So what this says is that once it gets to year 5, Coca-Cola is growing its free cash flow at 2.5% every year, but it's getting discounted at 7.2%. Because it's getting discounted at a higher rate than it's growing, eventually this is going to tend to 0, right? And you can see here, these look at the present values of Coca-Cola. You can see that every year the actual free cash flow is going down, right? Why is this free cash flow going down every year? It's going down because we're discounting it at 7.23%, but it's growing at 5 or 6%. So that's why these are going down. And then what you do is you add all these cash flows up. you use the enterprise value concept from earlier. So Coca-Cola has a bit of debt. We want to take that out to get the enterprise value. But by the way, it might also have some cash. So this is net borrowing. So debt minus cash. You get the equity value like that. Then you work out how many shares there are. And then you basically just divide all of this free cash flow by how many shares there are. And that gives you the intrinsic value of the company per share. And you compare that to the current share price, and it'll tell you if it's overvalued or undervalued. And that's kind of the way that I do it. I might let that sink in. Has anyone got any initial questions on that? No. Okay.
To send the Excel files later.
What's that? Sorry.
Can you send us the Excel files?
Yeah, of course. I can send you this Excel file
Or you
because
can practice it in your home. Okay.
you can do that. In fact, you can use this as a really good template. Like that's what I do. Like when I'm building a discounted cash flow for a new company, it's literally a case of like copy all this, like paste all of it, change all these assumptions down here, change the growth rates, and like it just all does it for you, which is great. And then okay, so here we have the debt. This is the average interest rate on corporate debt for Coca-Cola. You have how much tax they pay. As I said, that is tax deductible. This is me working out how much comes from debt and how much comes from equity. This is how I'm working out the discount rate of the equity. So the equation is the risk-free rate. As Prash mentioned, I'm basically using the 10-year federal note or what you can borrow from the government. US government's debt is pretty risk-free because they have the wealthiest population in the world to tax. They can just print money to pay off the debt, right? So they're never going to default on their debt. So this is a risk-free rate of getting money. It's currently about 1.5%. And then you also look at the volatility of the shares, right? So Coca-Cola is less volatile. Beta being less than 1 means the shares are less volatile. Beta being more than 1 means they're more volatile. If Coca-Cola is less than 1, it means that if we see a market crash, we're likely to see Coca-Cola fall less than the crash. So this beta helps to lower Coca-Cola's discount rate. If I move this beta up to 1.
I was just going to say, just for anyone that doesn't know, how would you go about calculating the beta?
Okay, so it basically just looks like the volatility. Usually it's daily, and it's like this is over a 1 year period, but you can do it over 10 years. It basically just looks like how much the shares have like moved compared to the market. That's basically what it is. So like if a share went up 50 cents every day, and the S&P 500 went up $1 every day, you'd add them all up, divide them by like how many number of periods or days you were using, and the beta would be 0.5. That's how you do it. Again, I would never bother to calculate this because like data providers just give it to you. Yes, say for example, we were to change this and the volatility of Coca-Cola went up. If it was 0.9, watch this cell here. The average discount of the equity would go up and the discount rate would also go up. Because you want to be compensated more for more volatility, because if there's a crash, then it would mean Coca-Cola's share price is likely to fall a lot more. And then how am I discounting the equity? It's a function of the risk-free rate, the beta, and the index return. So the more these three things go up, the higher the discount rate is going to be. If you want a higher rate for the market overall, that's going to push this up, right? Because you have a positive index return in here. 10-year federal note, again, whether this affects it positively or negatively depends on how volatile this beta is, because you have a plus and you have a minus in here. But then the beta is very, very significant in affecting this discount rate. And that's basically it. So you have the growth rate, you have the discount factor. Every year, you want to be discounting these shares by more and more. So the discount rate for year 1 is basically this. It's just that. For the second year, it's going to be the discount rate multiplied by 2. So the first year, we're discounting it by a factor of 1.07. The second year, it's going to be 1.15. So 1 plus this, and then you want to square it. And you're doing the same thing to the power of 3, to the power of 4, to the power of 5. For the terminal, we're not actually going any more years ahead. So we're going to do that to the power of 5 again. And that's basically how you do it. The other thing I wanted to show you guys is I don't like just saying these are what the well, I do like it, but like this is what the shares are worth, great. But like, you also want to consider the shares at different points in time. So you basically can like build the whole same thing again, and then you can basically make a matrix, and you can say if the free cash flow was to grow at this much, this is what the shares would be worth, and at different discount rates. And then you can say, oh, if it's at a 6% discount rate, the shares look very cheap. If it's at a 7% discount rate, it looks about right. 8%, quite expensive. 10% is obviously very expensive. So the higher the discount rate is, the harsher it's going to be with your valuation model as well, because you're wanting more, right? Like, again, remember this, like $100 now is equivalent to $106 next year. $100 now is equivalent to $110 next year. And then obviously the more the free cash flow growth assumptions go up, the higher the intrinsic value of your shares are going to be, or they're going to be projected to be. And it's also useful to compare this to what the analysts, I swear I have, yeah, here it is. I don't know what's happened to my, this is a little bit messed up, but basically the analysts were forecasting 5.5% geometric mean growth, 7.2% discount rate as I worked out. And that gives the shares about $45. These are slightly different because of some weird thing going on with the geometric mean, which I don't really need to explain, but they're going to be roughly the same. And you then just want to vary these assumptions. So like, for example, to work out this, put in a 2% discount rate here, put in, 2% free cash flow growth. Sorry, what am I doing? So, 2% free cash flow growth rate there, and then discount rate 6%. And you get your answer there, 57.39. 7%, I move the discount rate up. That's basically how I've been doing this, 44.65. And you kind of get the intrinsic value of the shares. Has anybody got any questions on this? Anything to add, David? I'm aware that I'm trying to go through a lot in a very short amount of time.
As I said, I think that's phenomenal. Are you happy to have this shared just very quickly, like the document itself?
Yeah, of course. Yeah, I can put this in the chat as soon as we're done. Like, I mean, it's so useful. Like, I build these like once. Well, I vary. You know, I improve on them over time. Like I add in more things. But like literally, the way I do it to like save time as an investor is I just go boom, like copy, paste, change the title, change all of these assumptions, change the free cash flow growth rates, and I can build a DCF in like 10 minutes.
Because I was going to say, like, if you are winning, which obviously you are, it's amazing because some online resources will charge you a good $500, $1,000 for this.
Really?
Not mentioning any names, but
really,
some companies that we're partnered with may or may not also charge that. So it's nice. It's nice to have that. And I was going to say, for anyone here that's is like seen this in a bit kind of, but would like to get started, what would be the first steps basically to do this? If they've got your template in front of them and they've cleared all the data, but they've still got the titles, you know, for each cell, what would be the first step to doing it?
So it's literally a case of like, go onto a data provider, find all of these free cash flow numbers. You can find 3-year forecasts with Yahoo, Seeking Alpha. As I said, I use SharePad, but they really are out there. Like, there's so many free data sources. You can find what analysts are projecting for free cash flow. You then basically look at these numbers, you know, plug in the growth rates, find out how much debt the company has, find out what their market cap is. This, you kind of have to do a little bit of digging in the annual report. You can also find that in the annual report pretty easily. If you can't, just use American corporation tax rate, which I believe is still 21%. If Biden hasn't hiked it yet, which I don't think he has yet, but he probably will. And then, yeah, I mean, that's pretty much, this is very easily obtainable. Just type in 10-year federal note into Google. You'll find that first search. Beta, again, a data provider. S&P long run return, that is 10%. That just is 10%. I mean, you can use 9% because it's sometimes, you know, depending on what it's usually between 9 and 10% will the S&P will return in the long run. But that's all very straightforward. Long run growth rate, I would use 2 or 2.5%, assuming the business just kind of grows in line with Inflation is usually between 2 and 3%. GDP growth is usually between 2 and 3%. Even population growth. Population growth is a little bit less. I think population grows at 0.9% in the US, but GDP inflation growth is about 2 or 3%. That's literally everything. That's literally everything. You want in here, if you can't find the like net borrowing, just do total borrowing minus cash and cash equivalents. You'll find them both on the balance sheet. I use diluted shares because some shares are like can be converted in like their options and like they can be converted into shares. Like management can like convert them into shares at certain prices. So I usually use diluted earnings per share. Sorry, diluted number of shares. And that's a bit more conservative as well because this number is usually higher than ordinary shares or shares outstanding.
Right. As I said, I think this is probably the most concise version of a DCF in terms of like an explanation I've ever seen, and definitely a lot easier than watching a 3-hour YouTube video, which I may or may not have done in the past.
Awesome.
So well done for that.
Thank you, buddy.
We'll get that Excel spreadsheet across to the WhatsApp chat.
Sure.
Do you have anything else to add before we call it a day and do the book giveaway?
I think if everyone's finding value from this session, I know we're at 7:30, but if you gave me 5 to 10 more minutes, I can show you another way that I do the intrinsic value that is very easy and simple. And I don't think many people really do it like this. Not exactly. Is that all right if we go 5 minutes over?
I have an idea.
All right.
Let's do the book giveaway, and then if anyone wants to leave, they can, and then
we can carry on. Yeah, sure.
Just because people at timetable for 7:30, they've got stuff to do. Anyone that wants to stay and watch it.
Okay, so let's do book giveaway, and then we can go. Then we can go ahead through the EPS valuation.
I'm looking forward to this though.
Cool, man. Let's do it. Gives me a time to go for a pee. I've had so many. I haven't had Coke since like last summer, or like I've had it last time in a restaurant, right? But like now it's just it's pretty funny because I was like today I'm just gonna buy some Coke for this valuation, and it's making me pee. So I'll be right back. But good luck to whoever wins the book.
It's a lot of information, but fair enough. All right, Ethan, let's spin this wheel and let's see who wins the book this time. So Zach, I'm just trying to find you in the chat. Hang on 1 second. Is Zach still here? Ethan, Zach has left the chat, so I would say spin it again. Unlucky, Zach. Just give someone else a chance. Adam Richardson, are you still with us? No, he's not.
Oh, no.
Right, third time lucky. Someone's got to win this book.
It's a really good book. Get it, actually.
And it is Sharif Khan Bennett.
Oh, good
well
luck.
done, Sharif. Congratulations. We will get that book to you ASAP. Apologies for anyone from I think it's the last week that we've not got the book to yet. The guild have just taken a bit of time to deal with, but everyone else, as far as I'm aware, has received their book hopefully so far. So, Sharif, we will get that to you. Well done. And yeah, if you want to stick around for Henry's other valuation method. If you don't, then have a great Monday evening. Please sign up for Fight 2021, the fundraiser. We've still got a week left, and you can still make a big difference to students who are struggling with mental health. And you can also win AirPods. And finally, if you want to be on our committee next year and take my position, take anyone's position, lead the biggest society on campus and one of the biggest societies in the country, then definitely send us an email before Friday, investment@guild.beham.ac.uk. I think that is everything from me. So Henry, take it away.
Right. Awesome. Okay. let's go through another valuation method. I think, okay, I'll just move this back on. I just want to say a couple more things on this. So number one, I really wanted to hammer home the point of complication in valuation, right? Like I get that this isn't like the simplest thing or like the easiest thing for people, but like, let's be honest, like compared to what some equity research analysts do, this isn't complicated, right? Like you're forecasting growth of cash flow, you're discounting it at an appropriate rate, you're adding them all up, and then you literally get out a value per share. What a lot of equity analysts will do, and to be honest, I think a lot of it is just to fill the time. So like they'll forecast the turnover, and then they'll forecast the margins, so you get net profit, and then they forecast how much net profit goes to operating cash flow. Then they'll forecast how much capital expenditure there is to then go to free cash flow, and then the growth rates are always so like insane. And I just think like the problem is there's so much room for error with that, that it's just like a lot of the time it's just not worth it because you could be wrong like somewhere, and there's just so much potential for error. And like I think it's much better to be roughly right rather than precisely wrong, right? And like the way that I will do investing, and I've moved much more towards this approach recently, is like I've moved from like let's just like really analyze the business 1,000,000% and like know everything about it, to like, you know, trying to get more in but like working on less per business. And it's not that I don't know the businesses that I invest in, it's just obviously there's that risk reward where it's like, okay, I'd rather analyze more in a little bit, and then I can aggregate a massive list of companies that are cheap, expensive, and then I can focus on buying them when they're cheap, right? So like, say for example, Coca-Cola is trading at 51. These shares, it says they're trading at 49 or 49.5. So like, I will keep this on my watch list, right? Like if these shares fall to 30 over the next couple of months, I will then have a look at this and I'll think, you know, are the free cash flows going to go down? Do the analysts think the free cash flows are going to go down? Has whatever has caused the shares to fall to 30 been worthwhile? If it's not, then I might buy the shares, right? Because at 30, there'd be 40% upside, right? No, even more than that. At 30, there would be almost 100% upside. So there'd be 30 over 20, so it's 20 over 30. There'd be 66.7% upside if it was trading at 30 and the shares are worth 50. And these matrices, again, these are really useful because you can say like, how aggressive do you want to be in the free cash flow growth? How conservative do you want to be as a discount rate? I highlighted this cell here because I think this is roughly right. Like I think it's roughly like 6% free cash flow growth. I think that's about right for Coca-Cola, given what the analysts are projecting. I think 7% is right because like it's a relatively low risk business. Like they've had quite a lot of headwinds at the moment because 50% of Coca-Cola is like sold outside of the shops, like it's sold in like bars and stuff, and people aren't really, you know, out and about at the moment because of COVID. So a 7% is about right, I reckon. But look, if you want to discount it a bit higher, the shares are looking expensive. My interpretation of this is that like I think the shares are roughly fair value. Like I think a 6% discount rate for Coca-Cola is too generous. I really do. I think 7% is about right. And then I think growth, we could see anywhere from 4 to 8. So like my interpretation of this matrix would be like, I wouldn't currently invest in Coca-Cola because there's so many shares that I do valuations of that I will get like almost this whole cell is green. I did one of, I'll tell you, I did one of Bristol Myers Squibb and the whole thing was green. And that was using even lower free cash flow growth rate. Okay. Anyone got any more questions on this before I show the other model?
Let me just check the chat.
Literally, like no question's a stupid question. Like this is not easy shit. I would rather anyone who asks, just feel free to ask, and everyone can get as much value out of this as possible.
Yeah, Will has just said, just to clarify, is it the present value, which is the number / value? Sorry, let me just repeat his question instead of trying to word it better because it was already good. Just to clarify, which number or value is the intrinsic value? Is it the present value?
Yes. Yeah, it is. And then this is the share price. And then this premium discount is basically just like the difference between them, or like, you know, like the percentage extra or the percentage. So like this is like it's like the percentage. So these are overvalued by 5% is what it told you. if, as I said, if the share price was like 30, this number is going to be what, like 64%, 65%. So yeah, that's basically how it works. So present value in this case is 50, or roughly 50. Current share price is 30. What that means is that if you bought the shares at 30 and they went to 49.57, you would return 65%. That's how you interpret this statistic. But the share price, what was it? 51.92. Yeah, 51.92. So at the moment, you know, the shares are overvalued, and if they go down by 5%, then they're like worth the same as what we think they're worth. But as I said, look, these are great, and it's great to have like one figure, but I wouldn't be too reliant on it. Like I would definitely just like have this tool that I built where you can value it at different rates just by putting in these two numbers. All you have to do is put in these two numbers into here, and you can like build this, and then you can say, oh, it's overvalued here, it's undervalued here. Right. As everyone know, we have Ashwath Damodaran coming tomorrow for Coventry Investment Society.
Yes, I know.
Yes. I want to ask him a question about the beta.
I was just going to say, for that talk, I completely forgot. It's really bad that it was tomorrow night. I thought it was Wednesday night. But that is going to be huge. So I recommend that you are all there. Sorry, shameless plug. But he's a professor. Is it from NYU?
I think so.
He's one of the big unis in America.
I've got his book right here.
He's regarded as like the king of valuation. It's not Henry Gardner Roberts. It's Ashwath Damodaran. So yeah, you got to be at that event 6:30 tomorrow. And the sign up link, I think we definitely sent it by email to all our members on yesterday. But if you didn't receive that email or you haven't checked it, let me know, and we'll send you the link. And you have to sign up before you attend. That's the only way to get the Zoom link.
Cool. Yeah, it's really interesting actually. Like, by sheer coincidence, I was trying to find out about this guy because he's written loads of books on value investing. This is just like a mini Bible summary version of it. It's the exact book we gave away last week, right before I even knew this talk was happening. And I was trying to find out more about him, and then like the next day, David's like, "Oh, we're linked up with Coventry Investment Society, and he's coming on," which is great because he really does know this stuff inside out. One thing I want to ask him is that, like, the stock market usually goes up, right? But the thing is that the beta being lower means that a stock would usually return less than the current market because the market usually goes up, and a beta less than 1 means that the stock is less volatile. But then it's almost a bit contradictory because a lower beta means a lower discount rate. So like all of these tech stocks that have returned absolutely loads, basically like they have high discount rates. They have higher discount rates from a higher beta, but like the beta is, because the stock market usually goes up, they're returning positively, right? And I'm just wondering if there's an improved beta that only measures when the market goes down. So like you could have a stock where like it barely goes anywhere when the market goes up. When the market goes down, it tanks, but the beta would still be quite low. I'm wondering if we could only measure the beta in a market crash, it'd be a much more great representation of beta compared to just like a beta every single day. I know that's a really random point, but it's just something I wanted to raise. And it's like one criticism of this model. And another thing I wanted to say, that's a bit of a criticism of this model. Look at these free cash flow, present value free cash flows, right? Like 8 billion, 8 billion, 8 billion, 8 billion, 8 billion, 8 billion. Terminal is 173 million. And like this terminal is like really heavily affected by this discount rate. So like small changes in this discount rate will like really move these shares around. So like if we move the beta around, okay, remember current value 49.57. If we move this beta to 1.4 to get an 11% discount rate, the shares are now worth 25. If we move the beta down to like, I don't know, 0.6, the shares are now worth 67. And yes, that's being affected by the beta, but it's also being affected by the discount rate. So what I wanted to say is that the discount rate heavily affects the share price, which is, again, why it's important to do this, because you can see it at different discount rates. So my other model, which I am getting to now, and I will show you, the discount rate is much less of a factor. It's still a factor, but it has much less influence over the company's intrinsic value. And I actually think that it makes much more sense because you don't have this like terminal value, which is like really, really high where you like sum them up. It's much more like focusing on the future or like the next 5 years as opposed to it all. And I've never seen any institution do exactly this. They will do elements of it, but they won't. I haven't seen many people do this. Well, I haven't seen anybody do it exactly. I'm sure somebody might, but I've never seen it. Right, here we go. So we're using earnings per share this time. Wait, before I go, do we have any more questions on DCF? Anything at all? I'd be very happy to answer it now.
I don't see anything in the chat. So,
okay.
So I want to ask the beta is can be using for measuring risk. If
measuring
beta
risk.
Is low.
Yeah.
Okay.
But what I would say,
the higher beta, the higher risk.
What's that? Sorry.
Yeah. The higher the beta, the higher the risk.
Exactly.
Okay.
But the point I was making a minute ago about the beta is that I don't always think that that's necessarily right. I mean, because like the higher the beta, the higher the risk, but also the higher the beta, the more the shares go up relative to the stock market. And that'd be great if the shares were going down most of the time, but the stock market goes up most of the time, right? So I'm saying that that's a potential criticism. And it's what I want to ask an expert like Ashrath next time, because like you have all these tech stocks that have really high betas, but like in the past year, they've just skyrocketed. And we're saying these skyrocketing stocks have high risk. Like sure, they'll have high risk if they're going down more than the market when the market goes down. But most of the days the beta's measured, the stock market goes up. So I'm wondering if there's a beta that only measures the market in a downturn, and that would be a much better proxy for risk. So yeah, it's actually it's a bit of a thing. Like people always say volatility equals risk, and it's not necessarily the case. Like volatility is a component of risk, as we see here, but it's not always the case. Like and particularly with value investing, if you have a share that's really volatile, but not much about the company is changing, it could be really volatile, but like it might be less risky, right? Like if a share goes down, like if it halves in value, or it halves in price, I should say, like shares go from $100 to $50, and not much has changed fundamentally about the company, or not much for you consider the value of the shares into half, then it's actually less risky because you're purchasing the shares cheaper, but it's more volatile, if you see what I mean. So like shares go down is volatility if they go down by a greater amount. But if you don't think much about the fundamental of companies has changed, it's less risky buying shares for $20 than it is $25 if you think they're worth the same amount. So volatility and risk, they do have some relation, but like they're certainly not equal. And I think that's a mistake that a lot of Wall Street make.
Okay, thanks.
Yeah, no worries, buddy. Right, so let's get on to earnings per share, because exactly what I said here is that like this discount rate, you change it slightly, this changes a lot. We want to get away from that a little bit. So this is why I built this. So earnings per share, what will I say about earnings per share? The most forecasted number in the whole of the financial scene is earnings per share. Like, if a company beats its earnings per share estimates when the annual report comes out or the earnings release comes out, the shares will usually go up. If they fail to beat their earnings per share, then the shares will usually go down. So earnings per share is really, really widely used. Why is that important? It's important because analysts will probably forecast it more accurately, and they'll pay much more attention to it than the free cash flow numbers. They'll still pay attention to the free cash flow numbers, but the market is paying the most attention to the earnings per share. And obviously it's important because even if the earnings per share is a little bit wrong, then the market will still react to that earnings per share. So what you do is we have Coca-Cola's earnings per share. This is in cents. So like their earnings per share is like $1.94 this year. And the share price is $50, right? So that's something important to mention, is that we're doing it on a per share basis. What you do is you forecast the earnings per share. This is what I do. This is again median analyst expectations. You can actually go on to seekingalpha.com. That's a platform I use, and you can also look at the range of earnings per share estimates. I take the median, but it's also important to look at the range, because like if the lowest was like 100 and the highest was like 300, then these aren't going to be very accurate. But like If the lowest were like 200 and the highest were like 230, then I'm pretty comfortable using 215, right? Particularly if the sample size of the analyst is quite high. And with Coca-Cola, you've probably got like 50 analysts covering it because like it's one of the most well-known stocks in history. So you have a lot of analysts forecasting it. So you look at these. You then do the discount rate. I've done the discount rate exactly the same way, but even though we're still using the discount rate, it's not as big a factor. So we discount these earnings per share. Sorry, that's the earnings growth. You discount the earnings per share. So 215 earnings per share next year, that'll be worth 200 in today's value. 232 this year will be worth 201. The discount rate is going up and up and up, as we saw, because we're forecasting further into the future. This should say E. E just stands for expected. And then that gives you the earnings per share present value. If you think about the price to earnings, sorry, this gives you the earnings per share present value. If you think about the price to earnings equation, so the PE ratio, then the earnings, sorry, the PE is the price divided by the earnings per share, right? So if we multiply the earnings per share by the PE, what do we get? Forecasted price, right? That's exactly what I'm doing. I'm just changing the equation around. So we're getting these two and forecasting the price. So I've got the earnings per share and then multiplying it by PE, and it's giving me a forecast. How am I getting this PE? I've looked at what Coca-Cola has done in the past, and I've taken an average out of it. You can see the past PE here. There's very little variance apart from 2017. If you look at what I've done with the average, I actually didn't use 2017. I used 2016, and then I used an average of these three, because these four overall have very little variance. So the PE for Coca-Cola is usually around 26. I then multiply all these by 26. I'm just dividing it by 100 to get from cents to dollars. And there you have the share price. Again, very little variance every year. It's implying these share prices. What you then do is you then take the average of all of these share prices to give you even further confidence and to kind of average out all of these earnings per share. And that kind of gives you the forecast. So it's looking like Coca-Cola again. I'm sorry, it's a boring one. It's about fair value. So the shares aren't looking that expensive, but they're not looking that cheap. That's basically the idea. Like when I say I haven't seen anybody do this before, I usually see analysts get their earnings per share and then multiply it by a PE. But I don't usually see them like really analyze the past PE. I also don't see them discount the PE, sorry, the earnings per share that often, which I find a bit bizarre. Because as we said, like $1 today is not worth $1 tomorrow. And that's how I do it. And I usually have much more confidence in this. Oh, not much more, but it's a good sign because, like, number one, this discount rate doesn't matter so much. Like, it's not as sensitive. Like, changing it is not as sensitive. It's much more sensitive to the earnings per share forecast and the PE ratio. So it's much more sensitive to this and to this. And then the other thing is that, like, you don't have some massive terminal value figure at the end, which is basically like all of this present value. Yeah, like, look, like this present value is like 214 billion, but 173 billion of that just comes from a terminal value. So what's that? Like 80% of it just comes from a terminal value, at least. That's basically how I do it. Anyone got any initial questions on this? This is something that I've only really started using in the past couple of months. So if anyone wants to poke some holes at it, we can, and we can have a think about it.
We got two great questions. First one from Will. Very simply, which model do you prefer? Does it depend on the stock you're looking at?
Yeah, good question. Okay, so with regards to which one I preferred, again, for what sometimes I lean towards this one, like discounted cash flow, adding up all the cash flows, great. Like, free cash flow, it is the core, what we're looking at in terms of earnings of the business. So I love free cash flow in that regard. I don't like free cash flow for the reasons I've just mentioned about this terminal value being huge and the discount rate being really sensitive. The earnings per share, one criticism of this is that, obviously, remember what we talked about earlier, right? Like PE ratio versus EV to EBITDA. The EV to EBITDA, I think, is much better. The only reason why I'm using price to earnings ratio is because the analysts focus so much on EPS. They focus so much on the earnings per share that like these numbers, they tend to be pretty accurate and pretty well forecasted. And it's what the market are pricing into the stock. This is what the market are pricing into the stock. So I like it in that regard. I also like this one. You can see its implied price over time, and you can take the average of it. So Coca-Cola, it gives me really high confidence in this intrinsic value for 52, because like, look at what they're valuing the shares at, right? Like 51, 52, 52, 53, 51.8, 51.74. Like it gives me a lot of confidence. It also depends on what kind of share it is. So like I've been doing a lot on defensive stocks recently. I've looked at Lockheed Martin, Raytheon, General Dynamics, L3 Harris. They have long-term contracts with the government, and they basically know what their free cash flow is going to be. So like it's very, very easy for them to forecast this, and it's very, very easy for me to have a high level of confidence. Even with Coca-Cola, it's relatively consistent. But like I was looking at Cineworld, and like you just never know what the free cash flow from Cineworld is going to be, given COVID, given Netflix, Disney Plus, how much a cinema is going to open, how is Cineworld's big acquisition in America going to go? You just never know. So for someone like Cineworld, I'd much prefer an earnings per share, and then look at what I think the PE multiple is going to be, and then use that. That's basically my question. That's my answer. There's no clear cut. As I said, I kind of prefer them for different things, but like I'd probably lean towards this one if I'm honest with you.
Cool. And the second one is from Andrew. Are there any companies you've looked at which have had a large variation between a DCF and the EPS valuations? Which is another great question. So well done, Andrew.
That's a really good question. Should we find out? Should we find out? Yeah, the answer off the top of my head is yes. And I'm going to show you guys something. I'm going to show you some recent stocks that I'm looking at. I won't. Can you still see my screen? Can you see my documents here?
Yeah, I can see everything, mate.
You can see this?
Mm-hmm.
Okay, just give me a sec. I'm someone who keeps my documents incredibly organized. Okay. Give me a sec. No, I don't want to be showing you that. Give me a second, because I want to. That's a really good question, and the answer is yes, but I want to see where the dispersion is. Let's look at this. Okay, here's some stocks I've been looking at recently. Here's my EPS. Here's my DCF. Okay, so firstly, look at this DCF, right? Some of them I get ridiculous, right? Like,
wait, Henry, we can only see Coke.
Oh, you can only see Coke?
Yeah, sorry.
Hang on a minute. Okay. I'm just going to share a different screen. Can you see that? No. Can you see this?
Yeah, there we go. Nice.
Okay. So here are some companies that I've been looking at recently. I build watch lists for them. I track their prices. Here's an EPS. Here's a DCF. So they're usually quite similar, or like there's a positive correlation, right? High DCF is higher EPS. IPG had a negative EPS. Sorry, it's expensive on an EPS basis, but it's cheap on a DCF basis. This is gone up in price. I reckon it's about $28.2 at the moment. So yeah, this is quite interesting. So my DCF still tells me that IPG is cheap, but my EPS doesn't. A reason why you would get that is that maybe the market isn't so bullish on EPS, but like the cash flows look very good. So obviously this is like going off what the market thinks on a price to earnings basis and what the analysts are forecasting for EPS. So like they don't think it's particularly as good, but the DCF, which is much more what you think about the free cash flow and like how generous the discount rate is, that's usually more of a personal like forecast, right? So that would be where you get the big dispersions. But as you can see, usually there's a positive correlation. Yeah, usually there's more variance in a DCF compared to an EPS. Cool. Does that answer your question, buddy?
Yeah, I think so.
Awesome. Right. That's that.
Henry, are you good to wrap up just as we're 8 o'clock and
Yeah, sure. I'll share this for one more. Okay, should we wrap? Were there any other questions?
nothing else in the chat?
I do have a couple more, but if you're pressed for time, then
Oh, go on. Can we do a couple more, David? Just a couple more. I'll be quick in the answers.
Yeah, sure.
My first one is, are you using this to set your target price for when you're planning to get out of the position?
Pretty much, yeah. So for example, like with Coca-Cola, I don't have a position at the moment because I saw them fair value, but like the way I do it, and this is what is great about value investing, is that it's a bastion of objectivity. So like you're like really disciplined with these prices and your price targets, is that, yeah, like you set it to like get out of position. And yeah, so what I do is I say if Coca-Cola was trading at like 40, and with this one it's great, right? Because like we have really similar present values. So like this one, 49.57, and then the EPS is like 52.6. I might then set a price target of 51. What I would then do is, I think we even spoke about this on Personal VM, is I would sell covered call options against $51. So that means that it's like keeping my discipline there. I wouldn't do that if I thought like something massive was going to happen with Coca-Cola that might change my valuation. But like Coca-Cola, it's a relatively stable business. In order to keep myself rational, if the share price was like 35, I would buy at 35. I probably wouldn't sell covered calls right away for 51 because that's so far out. Like the strike is so far out that like I probably wouldn't get any option premium. But like I would then, if the share price went up to like 40 or 45, and my valuations hadn't changed, I'd sell covered calls at 51. I'd then make money selling the covered calls. And then if Facebook goes up past 51, when those options expire, if the share price of Coca-Cola is above 51, like that's my downside. Like it's forced me to sell at 51, and it keeps my rationality there. So yeah, that's what I do. And like as I said, like I would aggregate a list. I've just shown you one of the lists that I like aggregate for companies, and it's great because you can analyze as many as you want, and many just buy the ones that are really cheap, right? Like you can analyze 5,000 companies. You probably need 15 for a healthy portfolio, and just buy the ones that are cheap. And like as they approach this fair value, you sell cover calls or sell them on. Okay, say for example Coca-Cola. If I was say like I think the shares are worth 50, if the shares go down to 40, if I'm happy to buy at 35, sell a put. And if the shares go to 35, then you're obligated to buy them at 35, which is great because you think they're cheap. You might not want to do that with a company that is very, very unstable, but hey, it's Coca-Cola. You know, we're gonna be drinking this shit for at least another 30 years. Relatively stable business model. You could sell a put at 35. If there's some short-term negativity, you've still bought something at 35, received premium for doing it, and you think the shares are worth 50. So it's like a win-win.
Further to the covered calls thing, if you've got your estimates for each year in your DCF, your EPS thing, could you sort of do like a rolling thing where you're for now, if you say like 6-month horizon on your covered call, you have the strike at something that's around your estimate for the end of 2022 or 2021, whatever it may be, and then you roll it on and increase that strike, so you just increase the amount of premium you're getting.
Yeah, you could. Yeah, you really could. To be fair, I've never really been in a situation where I've like done that. But yeah, you're right. Like if you had really high confidence in these estimates, then you could say, right, like the market isn't really pricing in much growth now. Okay, but like say if we had like, you know, this goes 300, this goes 350, this goes like 400, this goes 450. This is the kind of situation you're talking about, right? For like 2021. Okay, also say the shares are worth 40. You could sell strikes at 50 here. Like the shares will go up to like 50, 60 next year. Then you could start selling cover calls at this option. Then you could sell cover calls here in the year after. Yeah, you could 100% do that. I mean, I would only do that if I had high confidence in these estimates, because obviously, yeah, they're not absolutely right. But like if the analysts had like a really narrow range, and also I thought they were growing at the right price at the right time, like if the range was like 290 to 310 on this one, then that would certainly give you confidence to like sell cover calls and constantly raise your strike. That's a really good question.
I keep thinking more, sorry. With the analyst estimates, so you're looking at a variety of them. Do you ever come with your own estimate, or do you only ever look at the analyst ones? Because obviously, I guess the whole GameStop thing is kind of highlighting that perhaps these firms have their own interests at heart when they're providing these valuations. If they've got a short interest, they might not put a pessimistic valuation versus if they've got a large long position. So do you look at all of these firms and try and find out if they've got a position in that stock when you're taking their valuation figures, or are you just blindly doing an average? And
I mean, that's a really, really good question as well. There's a lot of things to say. The first thing I'd say is that research can be very biased. I mentioned it can be, right? I think we talked about this as well. On the sell side, you've got obviously the analysts trying to market the research. They might, in their proprietary trading, they might have a position in the company, which then allows them to be biased. They might have good relations in the company. They might be completing, I don't know, an acquisition deal, right? Like go back, Facebook is acquiring WhatsApp for however much they acquired it for. They obviously, the bank wants to, if the bank's working with Facebook for that huge acquisition, they want to be nice to Facebook, right? So they will probably be biased and they'll probably raise the target a bit higher. So yeah, that is always something to consider. And the thing I'd say in that is that like, this is why I really like Morningstar, who are kind of like, they're independent of all of this sell side bullshit going on. They're purely like a research firm. So like I tend to look at them, and I will look at how the analysts are kind of valuing the shares. I will also consider, this is why it's important to have the past on here as well as the future. So like I'll also consider like how they're looking compared to the past. And then I'll also look at how they are building how they are valuing their own shares. So for example, like I was looking at like Shopify, a Credit Suisse report on Shopify that said Shopify was really, really undervalued. And it was like, I go into the valuation notes and they're like, oh, we're forecasting a forward like 250 times EV to EBITDA. And like you crazy. Like the problem is like with really, really high growth businesses is like, you have to be so confident in that growth of a technology in order to value them like that. And like, that does make me think like, I tend to avoid situations like that, where like, it's like a ridiculously high company with a ridiculously high growth rate, because it's just so difficult to value. I much prefer companies that have been around for a long time and their like growth estimates are much more stable. So yeah, to answer your question, very, very good point. I do look at non-biased research. I look at how the analysts are valuing the shares. And it's also important to consider where the analysts' interests are with the stock, particularly if they're on the sell side. You go onto Argus Research at the moment, you look at one of their reports, it will say, we are 65% buy in the market, 34% of our positions are hold, and 1% are a sell. Do you think that's representative of the current market? No, it's not. It's biased towards the buy. Why is it biased towards the buy? Because most people that buy that research are mutual funds. Mutual funds can only buy shares, and obviously they will sell research reports which have a buy rating, because then the analyst takes interest in it. But yeah, really good question.
I've got another one again, sorry.
All right.
With the, can you, all these databases like you've got or you're using to find out these ratios, do they have previous analyst estimates on them as well? So let's say you're looking at the 2017 and 2016 analyst estimates, you can have a row on there to compare your actual EPS or your valuation of the company with an analyst estimate. Mm-hmm. You get a historical comparison to see how far off the analysts are. I guess maybe use that as like a confidence for your predictions on the future ones, perhaps.
It's a good point. Again, it's a good point. Like, the best way I use that, I don't know if you'd have to have a membership for this, but I use Seeking Alpha. They have a really nice quarter by quarter thing where it's just like, company beat analyst estimates by 5 cents. Company missed analyst estimates by like 1 cent. And as I said, like that's usually a driving factor in the share price on results day. So that's probably the best thing to use. If you consistently see the company beating analyst estimates, it's usually a good sign, because like the analysts are like underappreciating the value of the shares, which usually means that they will go up. But then the disadvantage of that is like, then this model usually won't be as good because you're looking at analyst estimates and you're looking at a PE. This is where the discounted cash flow is usually a lot better, because it's slightly less bias. And like I said, usually I put the analyst estimates in here as kind of like a proxy. but like, you can put your own estimates in here as well. And sometimes I will put my own estimates in here. So like Lockheed Martin, I had a look at the analyst estimates, and they weren't consistent with what the CFO was saying on the earnings call. So I used what the CFO was saying on the earnings call. You can only do that because Lockheed Martin are a defense contractor. They supply airplanes and helicopters to the US government. So their free cash flow is very stable because they're in long-term contracts. I use that free cash flow, and it's much better. So yeah, it's good to see what the analysts were doing in the past. If you're saying they beat estimate, that's usually a good idea that they are potentially gonna do well in the future. Because like when it's beat earnings, the share price usually goes up after the report, after the earnings tool comes out. But then it might mean that with models like this, they might actually be underappreciating the stock because you're basing it so heavily on what the institutions think rather than necessarily your own kind of merit of the stock. Yeah.
This question I've got now is probably going to have an hour answer in itself, but like, what are these analysts doing, or if you're coming up with your own estimate, what are they doing to come up with that number?
Well, they're basically doing all of the stuff that I've decided not to do independently because it takes so much time and effort, and it's just not worth it for a one-man band, particularly when you can get these figures and you can, you know, they're usually relatively accurate. So they'll literally start like top line, like turnover. They'll like have so many assumptions about the business, like so many assumptions about the turnover, like what's driving their margins, like all the stuff like research and development, operating expenses, like everything, how much they're spending on capital expenditure. Like that's where they'll get, well, not capital expenditure for earnings per share, but like that's where they'll get all of these numbers from. And yeah, like that's how they do it. They really do it line by line. And I mean, sure, that's probably useful, but like my argument is like you can get like 90% of the work done in like 1% of the time. And for me, it's like a one-man band. I could sit here and I could spend like 20 hours of my life like forecasting every minute detail of the business, or I could spend like 20 minutes like copy and pasting this template, putting in the numbers and getting a rough valuation estimate, and then being able to aggregate that and look at like 50 companies at once. Yeah. Good questions.
All right, Henry. I'm really sorry, but it is 8:10.
All right.
But I will say, if anyone has any follow-up questions to the session, obviously we encourage it. So get in touch either on the Alpha chat directly with one of us, probably Henry, because he's got more chance of answering it correctly than me. But yeah, we really, value the fact that you've stayed on for almost an hour and 3/4 just to hear Henry speak about valuation. So thank you for giving up your Monday evening, or the majority of it. Go have a good evening. Thank you again, Henry, for a really great session. We've got a lot of good feedback in the chat. I've received a lot of messages privately saying it was really useful. So
wonderful.
Thank you for that. And tomorrow night it is Ashwath Damaran, right?
That's it.
I've got his name right. Yeah, cool.
Damodaran, or yeah, I think it's Damodaran. But yeah.
Damodaran. My apologies. He is a living legend in valuation, so I need to get that right before tomorrow. But make sure you are there. It's 6:30 normal time. As I said, you need to sign up using the link that we sent in the email, and you'll receive the Zoom link from Coventry Investment Society, who are technically hosting it with us. And yeah, see you tomorrow night. Please sign up to be part of our committee for next year. We need people on board. We want a really strong committee to take the society even further than where it's come from this year. And Fight 2021 fundraiser, get involved, run, walk, cycle, donate, win some AirPods, whatever you want, go do that now. Check out our Instagram, and that is the place to find out everything else. Otherwise, gosh, that's a lot of information. My bad. Enjoy it. I feel like you cramming that all into an hour and a bit. But go enjoy your Monday evening. Go have a drink or 5.
Yeah.
And yeah.
Just wanted to say before everyone goes, like particularly kudos to you if you're still here. Like, I mean, that's really good. I mean, number one, like, it's great that obviously these sessions are adding value to people. But like, I just went through some really complicated shit, and like you guys having the commitment to like stay and like learn about it, and like the fact that you're still relatively engaged with this stuff is really awesome. It's really nice. And
this is what we built the society for, right?
Exactly.
So it's really special to see. So
And
thank you.
congratulations to anyone who was here for all of the sessions, right? There's certificates going around. This isn't going to be the last Investing 101 at all. It's probably going to be the last weekly one from me. But yeah, like I'm very happy to do more for next term. I have covered a lot of what I can cover in terms of basic Investing 101, but there will be topics. There will be topics for next term. So just let me know. Oh yeah, Coca-Cola, we went through the valuation tonight. I'm probably going to publish an analysis on the whole company on YouTube tomorrow. If anybody wants to see that on my channel, I'll go through a bit more about their business model and like whether it's a quality company. And like, that's still important to know, right? Because like if the shares drop 20% and you think they're cheap, do you also like the business? Like, is it a good time to buy the business? And any requests anybody has for my YouTube channel, these stock pitches seem to be getting the most attention and seem to be adding the most value. So if anybody wants a stock analysis done, please send it to me. I can't promise I'll do it immediately, but I will try and get around to it because that's the direction I'm taking the channel in, and I'll kind of do an analysis on an investment for you. But yeah, thanks again for joining, everybody. It's really nice to have so much engagement, and enjoy the rest of your Monday night.
Thank you, and thank you, Henry. All right, good night, everyone.
Good night, everyone.
I'm starving. I'm absolutely starving, Henry.